So let's start with the first guest. Peter, welcome to the show.
Good to be back.
Glad you're here. All right, it's been a little bit. Give our audience some background on you, and then let's talk about your outlook for the market, what you see happening.
Sure. My name is Peter Cardillo, and I'm the chief market economist at Spartan Capital Securities in New York City. We're basically a small boutique firm catering both domestically and internationally at all levels of investments.
Right. So not only investment marketing or investment trading, but I see also investment banking and corporate affiliates.
That's correct.
Wealth management. Okay, great. You're here today, though, to talk about what's going on in the world, right?
That's correct.
Let me have it.
Well, we're basically looking at a global situation that is pretty good at this time. And, of course, as we look at our own domestic situation, obviously it continues to improve. In fact, today's macro data was really good. We had a surprise jump in non-farms of 223,000 when the consensus and I myself were looking for around 190,000. And, of course, the unemployment rate, that is total unemployment, shrank to 3.8%. Certainly, that means that the labor market is continuing to tighten, and obviously that's good news for the economy. However, it does have a somewhat of a negative effect in the sense that it guarantees, at least a near guarantee, I should say, that we're looking at a rate hike in June, and possibly, if this situation continues, a Fed that's probably going to be a little bit more aggressive this year.
Okay. All right. I'm looking at the bonds. It looks like they just basically did nothing, a little whipsaw on the market today. So you're expecting higher rates like the rest of us, right?
That's right. And I am expecting not 2 more rates, but possibly 3 rates. And that's based on the economic activity and the fact that we're probably headed for higher inflation. In fact, this is about the second or third month where inflation actually has stayed slightly above the 2% Fed target rate. And so if that continues, certainly the normality of rates is going to be sooner than later.
Okay. All right. Let me get this straight. If you're looking for higher rates of inflation, are you talking about that being reflected in, say, the price of metals, a dropping dollar, or are you talking about something longer term, more in wage inflation versus other areas that we see that showing?
Well, wage inflation. Let's talk a little bit about that. Obviously, we saw wages go up a little bit. If you looked at the hourly wages in the employment report today, they were up, but not excessively. So we're not seeing just yet, and I want to underline that, any real movement in terms of galloping wages. However, if the economy, if the labor market continues to expand at this pace and continues to tighten, there will come a point in time where we will see employees demanding more from their employers, and so that means higher wages down the road, and that will not be good news as far as the Feds are concerned.
Well, let me back up. Give me your impression, your thoughts about oil and gold.
Well, oil, I'm very bullish on oil. Look, if you look at the global economy, we're probably growing maybe just slightly under 4% this year, which is good news. And so demand is quite strong. Now, we've had a setback, and that setback, I think, was intentionally on the part of OPEC because, last week there was an open discussion between the Saudis and Russia about perhaps easing their production quotas at this month's meeting. And so that caused the market to pull back. We've had a healthy correction. I do admit that we have we've had some technical erosion, but I think we're probably going to settle down around the $65 area and build a good base to rally back up. Now, I also think that
let me jump in there and just stay on track with you on this one here. We're at 65.70 right now. I've got people telling me that we could be seeing $80 to $100 barrel of oil over the next 6 months. I'm
not sure about $100,
yeah.
but $80.
Yeah,
I'm in that camp, absolutely. What I was saying was we've had technical damage, so it's going to take a little while for the market to do some build basing around here, and then after that, I think it responds to the key factor of the energy market right now, which is strong demand. And another important factor to dwell on is the fact that yes, the U.S. is pumping at full speed ahead, but guess what? It can't meet all of the demand, and so if OPEC, and I kind of suspect that they're not going to ease their production this time around. They may do it in September or by the end of the year. If that happens, then you will see $75, $80 oil rather quickly.
Is that going to give us a negative impact on the price of the, let's say, S&P, the Dow, and the rest of the indexes?
No, none unless it, on a transitory inflation basis, we'll begin to see those numbers go up. But the Fed really is not too concerned about that. So I don't think so, because actually you have to look at it from the standpoint that it's bullish for the economies, because it means the economies are progressively improving, and the demand for oil corresponds to a strong economic environment.
Okay, so what I'm hearing from you is you don't see a continued downtrend in the market, even though we're seeing higher prices in crude oil. It's not going to negatively impact. That's just because it's a demand for a growing economy for petrochemicals.
That's correct. Unless you begin to see a big trend rise in all commodities prices, in all sectors of the commodity world, and that's not going to happen.
Let me jump out there with another quick question before we have to close here. It's been my impression, and I haven't been, trading the market very long, but just, since 1980. But it's been my impression that when you see higher interest rates, you get a bigger spread on the financial industry, the lending institutions. Are you thinking that we're going to see that? And I don't want to pin you down into a particular sector, but the financial sector, the lending institutions are going to benefit greatly from higher rates in the near term?
Well, I think, it has a negative and a plus. And it's quite obvious that higher interest rates are going to favor one sector over the other sector.
Right. That's what I'm asking. Yeah, it seems to me Citibank, Bank of America, J.P. Morgan, these major institutional investment houses are going to take advantage of that spread as the Fed raises rates. Impressions?
Well, I think you're correct on that.
Okay, I'm just kind of curious. Hey, we've got to pop out of here, but before we go, please, contact information so we can reach out to you.
Sure. You can call me at 212-660-5681. That's my landline. And if someone has an emergency, you can call me on my cell at 917-678-3887. And we're ready to help you here at Spartan Capital Securities.
It's been fun sparring with you, Peter. Thanks for being here.
My pleasure.
My pleasure, too. Peter Cardillo, Chief Market Economist, Spartan Capital, SpartanCapital.com. You can listen to CEO Money with Michael Yorbis, segment brought to you by The Vitamin Patch. We're going to take a break and come back with a private equity spotlight right on the other side of this.